My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people make friends. I'm just trying to save you a little money. My job is not just to entertain, but to put days like today into context so you understand them. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. When the bond market's in charge, you aren't going to make much money in the stock market because bond owners are pessimists, real glass half empty guys. And the bond market is certainly in charge right now. See, today we saw exactly how pessimistic they really are when they overlooked very weak consumer confidence data and averted eyes from an amazingly weak Chicago Purchasing Managers Report, 17-month low, both signs that we're making progress in the fight against inflation. Instead, they focused on a slightly hotter than expected employee wage figure. The results? Bond yields moved up slightly and the stock market got annihilated. The Dow tumbling 570 points. Sell. S&P plunging 1.57%, and the Nasdaq plummeting 2.04%. April of 2024 will now go down as the worst month for the Dow since September of 2022. Good riddance. Now we're on the verge of a Fed meeting tomorrow that will no doubt show that Jay Powell wants to keep interest rates up higher for longer because the popular perception is that the economy isn't weakening. Notice, I put it that way, popular perception, because I see brown shoots all over the place. What are brown shoots? They're the opposite of green shoots. You want to see green shoots when you're hoping for the economy to bounce back from recession. I made up the term brown shoots because right now we want a slower economy so that the Fed can eventually start cutting interest rates rather than looking like bozos for taking more rate hikes off the table. So we're looking for brown shoots everywhere, like those weaker consumer confidence numbers and the Chicago PMI figures from this morning, or perhaps the miserable numbers from Starbucks tonight, big company, and filing them away as brown shoots that remind us that the Fed needs to keep rate cuts on the table. And remember, they are the magic elixir for stocks going higher. Ever since March 8th, we've got a much hotter than expected employment number looking at us. We've been worried that the Fed stopped tightening too soon. It's not a coincidence that some of the greatest stocks of the year, like Nvidia, peaked and fell that particular day, because nothing's more important to the broader economy than employment. If it stays strong, then we probably have to have more rate hikes. If Friday's April payrolls report is weaker than expected, though, there's a very good chance that all this negativity about stocks will go away again. Wall Street wants weakness because it will mean the Fed was right and rate cuts are on the horizon. But there's no bridge from here to there, which makes things more fraught than we imagine. Take the indicators today. When consumer confidence nosedives, as we know it now did, and when the Chicago PMI goes down so much, normally we wouldn't even bother with this employment cost index. The bond guys I deal with told me that the employment cost index, the one that rose 1.2% when people were expecting just 1%, was a suddenly important indicator. All important, that Jay Powell had mentioned a couple of times is significant, as if somehow the PMI, the consumer confidence numbers, don't mean it's much anymore. I think that's ridiculous. What truly matters to this market is that we've got plenty of investors who are still clinging for or holding out for a whole bunch of rate cuts this year. And until they give up on that idea, they're going to keep dumping stocks anytime we get one piece of strong economic data, no matter what it is. Oh, it's a tough needle to thread. Consider this. We had two very weak numbers today, one relatively strong number, even though that strong number hadn't really been mattering before, and suddenly it was enough to cause real havoc. In fact, it was so bad today that the real standout stocks were the perennial loser cannabis plays, because DEA now plans to recommend that cannabis be reclassified as something less risky. The star of this whole session was Canopy Growth, my favorite pot stock, so to speak at least, which was up a stunning 78%. Sure enough, Eli Lilly had a great day on a terrific quarter related to the sales of the GLP-1 weight loss and diabetes drugs. 3M gave you a long-deserved upside surprise, even as it came with a dividend cut. But for the most part, the bond market crushed the stock market yet again. Now, I want to step back for a moment and tell you how I see this meltdown. First, it's the end of the month, and money managers like to sell stocks en masse at the end of a month that's been bad. So we might actually be wading through some sort of technical morass that we don't even know about. Second, with consumer confidence for April falling to the lowest level since July of 2022, that's more likely going to produce a softer set of retail numbers, something the Fed very much wants to see. Consumers get negative for a bunch of reasons. It could be the college protests that dominate the headlines. It could be the fraught presidential election. Or it could be because people are suddenly worried about keeping their jobs. And that's something that may weigh on Friday's non-farm payroll number. If it's weak, again, the ultimate brown shoe. Third, today's weak Chicago PMI number could be a sign the U.S. economy juggernaut may have run out of steam, or at least isn't operating as hot as it's been. Again, another used brown shoe that jives with what we heard from some of the railroads and trucking companies, which I regard as great barometers of the future. Now, the big downer here is that no matter what we do, we keep hearing that inflation's raging. We ignore that Walmart's coming out with a new line of house brands that are cheaper and can help push down costs. We don't seem to notice that we're now getting some weird numbers from companies that deal, say, with car parts, numbers that say that people aren't putting in for insurance claims because insurance is already too expensive. The rising price of insurance happens to be a huge source of inflation. We've got some commodities that are plummeting, too. Today's victim, including cocoa. Remember, I told you that thing was going to just break. Cotton, coffee, even oil seems to be stabilizing for the moment. But we have nothing promising when it comes to shelter, the other major source of inflation. And we have anecdotal information like that of Coca-Cola, which put through big price increases. It didn't hurt sales. We are going to talk to Coca-Cola's James Quincy later in the show. All these indicators point to one thing, though. The Fed may need to leave rates as high as they are for a time, which is not great. But remember, a couple weeks ago, many people were arguing that the economy was so strong the Fed needed to hit us with more rate hikes. I'm sure Jay Powell will get a question at the press conference tomorrow that sounds something like this, and I quote, "What do you say to people who might suggest that the next move in rates is actually up, not down?" End quote. Sure, he might just say, "They know nothing!" But I bet he says something like this: "We're monitoring all data, but so far we are right to keep rates higher for longer." To me, that's actually enough maybe to get the market back on kilter. So let me give you my bottom line on this odd day. Did we really plunge more than 1% because of the bond market, which stumbled because of a slightly overheated employee cost index number? Or did we really hold out hopes for higher stock prices smack in the middle of earnings season on the seesaw of the 10-year Treasury, which had a slight bump in yield? Or was it simply the end of a rough April where we were often met with selling at the end of the month? Every year, there are people who want to get out ahead of the sell in May and go away crowd. If that's the case, we could right the ship tomorrow if Jay Powell acknowledges some brown shoots. Personally, that's my preferred explanation. Let's take calls. Let's go to David in California. David.
Yes, I'm here, Jim.
Hi, David. What do you got for me?
First of all, thanks very much for all your good works. I'm interested in Robinhood. Buy, sell, or hold?
Okay, Robinhood had this gigantic move up, and it is now pulling back, and I don't think the pullback is finished. The rally occurred in large part because of a big short position. I think we've got to wait and see. I would not wade in. I would not go either way on the stock right now. Okay, listen, every year there are people who want to get out ahead of this sell in May and go away crowd, and that actually is my preferred explanation for today's decline, not the big jump in yields, because we didn't have one. On Made Money tonight, there was a glimmer of green in today's sea of red in the form of Restaurant Brands International. I'm hearing how the company behind Popeyes and Burger King is continuing to execute, and that'll be with Executive Chairman Pat Doyle. Then American Express held an investor day earlier today, so I went straight to the source for an exclusive with the CEO to learn more about how the company keeps hitting it out of the park. And Coca-Cola reported a good quarter today in a tough tape, which sent the stock lower. But was the downward slide warranted? I'm digging into the numbers with the CEO, so stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.